and welcome to Finforall by Jupiter. My name is Dipansha Dhingra and today we are going to discuss some of the best tax deduction investments you can make to ensure that you finally go on that Goa trip you have been planning since forever. There are many smart ways of saving taxes and enjoying maximum benefits. But most people have the same attitude towards financial planning as they do towards homework. Kal dekh lenge na yaar. If this is you, then this video might just help you out. When it comes to tax saving, understanding Section 80C of your income tax declaration is quite important. Section 80C, including Sections 80CCC and 80CCD, prescribes a combination of activities. If you invest in these activities with your salary, then the investment is deducted from your total taxable income. The total amount that can be claimed under Section 80C and its subsections 80CCC and 80CCD1 combined is 1,50,000 rupees. What that means is, if your gross salary is 10 lakh per annum and you invest 1.5 lakhs in activities under 80C or any of its subsections, your total taxable income becomes 10 lakhs minus 1.5 lakhs, that is 8.5 lakhs. This is obviously very handy, because on 10 lakhs annually you would pay 1,12,500 as taxes, which is assuming you do not have any loans or premiums. But if your taxable income becomes 8.5 lakhs, you will be paying 82,500, which is a straight up profit of 30,000 rupees. Of course, this is very basic math and things change according to what you invest in. Now let's jump into 3 of the best options to invest in. Number 1, Equity Linked Savings Scheme Mutual Fund. ELSS funds are those funds that invest 80% of your investable corpus in equity or equity-related instruments, mostly across a diverse group of companies. ELSS funds offer an interest rate of somewhere between 5 to 18%. However, the returns are not fixed in an equity-linked savings scheme and vary according to the market performance of the fund. There are 3 important things to remember in this. Firstly, this investment is tax exempted up to the standard 1.5 lakh rupees limit. Second, it has a lock-in period of 3 years. And third, you pay 10% taxes on your profits or long-term capital gains, also known as LTCG, at the end of 3 years only if the profits are more than 1 lakh rupees. Number 2, National Pension Scheme. National Pension Scheme (NPS) is a voluntary defined contribution retirement savings scheme designed to help you to make optimum decisions regarding your future through systematic savings during your working life. This is easily one of the most popular tax saving schemes for 3 reasons. It's tax exempted up to 1.5 lakhs under Section 80C. Under subsection 80CCD1B, you can get an additional deduction up to 50,000 rupees. If 10% of the basic salary of the individual is contributed by the employer in the national pension scheme, then the amount is not taxed. Remember, this is 10% of your basic salary, not gross. The basic pay is usually 40% of the gross salary, meaning if you make 1 lakh a month, your basic pay would be 40,000 rupees, of which a standard 10%, meaning 4,000 rupees, can be contributed by your employer to NPS. And this amount is untaxed. Although the trifecta of benefits is very popular with the investors, you should also remember what to expect during maturity. Number 1, only 40% of the fund is tax exempted at maturity. Number 2, it is also mandatory to invest a minimum 40% of the fund in annuity. Annuity plan is basically what provides long-term dividends as monthly payments. So the more you invest in annuity, the more your pension. Third, monthly income earned through these dividends is also taxable. Also, you cannot make any withdrawals from NPS before retirement except under specific circumstances. As a government-backed tax-saving investment, the NPS provides safety and transparency in investment. The costs of investment in NPS are very low and you can start with a minimum amount of just 500 rupees. You can find a link to the official NPS pension calculator in the description. Number 3, Public Provident Fund, PPF. PPF is a popular long-term tax saving in investment scheme, mainly because of its triple E status, that is exempt, exempt and exempt. This means that the contribution made towards the PPF account, the interest earned and maturity proceeds are all tax exempted. The interest rate on the PPF balance is reset every quarter, although the risk factor remains relatively stable because, again, this is a government-backed investment. The Public Provident Fund has a maturity period of 15 years that can be further extended for 5 years. Unlike the NPS though, partial withdrawals are allowed from the 6th financial year from the date of initiation. Basically, if you started in June 2020, you can start withdrawing from the financial year starting on 1st April 2025. As a government-initiated savings scheme, PPF also offers ease of investment from as little as 500 rupees. You can contribute a maximum of rupees 1.5 lakh in a year. Moreover, you have the choice to contribute either in monthly installments or a lump sum amount. There are of course many other options to invest in, which we will cover in detail in other videos. It's already enough gyan for one day. But we would like to leave with a PSA that planning for retirement is cool and very much needed, now that many companies don't offer the usual pension schemes like they used to. That being said, research and educate yourself about the different kinds of investments and how you can maximize your benefits. Yes, we know nobody wants to study, but do it like your life depends on it. Because it kinda does. There are some useful tax calculators and planners online. Some of them are linked in the description too. Until next time. Thank you for staying tuned. For more on finance and everything beyond, follow Finforall by Jupiter on YouTube, Instagram and LinkedIn. Don't forget to leave a like and share your views in the comments below.